You're listening to Today. I'm Xu Jinduo with Ben Liang. Now, for today's business stories, here's Zhao.
Well, thank you, Qingduo. Let's now check out some of the key events in the business world in China this week. And join me on the line is Jeffrey Towson, Professor of Investment at Peking University, Guanghua School of Management. Jeffrey, actually, we start with the latest news is China's central bank has called on the nation's biggest lenders to speed up the granting of the home loans and to set mortgage rates at reasonable levels. So it urged commercial banks to give priority to families buying their first homes and strengthening their monitoring of the credit risks. This is the latest move following the home sales falling 18% in April from the previous months. So this is actually a signal from the central bank to support the flagging property market, but it's a window guidelines or guidance from the central bank. And will this have significant impact on bank lending practice?
Yeah, it's sort of gotten a mixed response because it's not a direct action like changing the reserve ratio where it's going to actually change liquidity. This is more of guidance. It's a little bit vague. I read this as sort of an ongoing process of the government sort of driving the car with one foot on the gas and one foot on the brake.
Yeah, because actually we know that for the past 4 years, China has enacted restrictions to cool the housing market. And during the booming years, speculators using a lot of shadow financing, non-bank loans helped spur the construction of access housing across the country. And now it seems that over 10 million homes sit empty here in China. And but this time it seems that the central government or the central bank actually signal another kind of policy, right?
Well, they want to keep the supply down. That's sort of what's a little out of control, that developers borrow money usually through shadow banking and they build these units and then they sit empty. So they are trying to keep that process down, which is sort of the foot on the brake. At the same time, they don't want demand for housing to fall, because when demand falls, the prices fall. So they're sort of, easing up on that side and letting people buy first homes easier, making it easier to get their mortgage. So they want to sort of keep the demand maybe higher than it is, but at the same time not open the floodgates on supply again. So you can see them sort of balancing between these two goals.
And another news, the Asian Development Bank has recently held its conference in Kazakhstan. And during the event, the Chinese finance minister held a discussion meeting with 15 other countries on the potential creation of a new Asian infrastructure bank. So, Jeff, what distinguishes this bank from the World Bank and the Asian Development Bank? It will be mostly led by China. It is a China-led initiative, and the $50 billion US dollars in the initial discussed fund is mostly will coming from China, right?
Right. I think what got everyone's attention on this was, well, it's a very natural idea that there should be a multinational development group led by China. Because the World Bank is to some degree led by the United States, and the Asian Development Bank, which is based in Manila, is, the U.S. and Japan are sort of the larger forces behind that. So it's natural that China would also create its own initiative. What I think got people's attention was when they had the meeting in Kazakhstan to discuss this, neither India nor Japan were invited to the meeting.
So it seems that some analysts say it's definitely appears to counterbalance the U.S. and Japan in the region. Do you agree with that?
India, I think, is an easier case because India is seen as an economic competitor. So India wasn't invited, but Sri Lanka and Pakistan were. But Japan, obviously, given what's going on in the region in the South China Sea, that one starts to have sort of some appearance of political, alliances and that. So that one, I think, given what's going on in the news, also plays into that political, not just purely economic competition. And you could even take that one step further and say, you know, the Asian Development Bank, which this group would really compete with, is based in Manila. And there's some stuff going on between the Philippines and China, you know, this month. So, yeah, there's overtones of all of that.
And moving on in the business and corporate front, Chinese automaker Great Wall has announced the suspension of its new H8 SUV. This was their first car for the upscale market, basically for cars above $30,000. So this is the segment of the market dominated by GM, by Ford, and by other foreign automakers. So, Jeff, what happened? Wasn't this really the first attempt by Chinese automakers to move out of cheaper discount cars and compete directly with the foreign automakers in upscale cars?
Yeah, I think this is an important story, and I like Great Wall, and I have a lot of respect for what they've done here. Typically in these sectors that are a lot of manufacturing based, like making cars, what you often see is you see foreign multinationals sort of dominating at upscale, higher priced cars, and they have a lot of brand and technology is their strength. And Chinese automakers sort of do real well at lower, cheaper cars, which is more about cost structure. And the question is always, well, when do the Chinese companies start moving upscale, or the foreign companies start making cheaper ones? When do they move into the other's territory? And Great Wall made a very significant announcement a couple years ago that they wanted to move upscale. They built very large factories in Baoding. They hired thousands of engineers, and this was really their first attempt to move up into that. They do incredibly well in SUVs at the lower level. And then there were some problems with the cars, and they basically announced an indefinite suspension. So they sort of took their shot, and it looks like they're retreating a little bit right now, and will probably come at it again. But I mean, it's an impressive move. It's the first time we've seen this.
But Great Wall has also announced falling sales internationally, and they had other bad news in 2012 when they had an asbestos problem in their cars in Australia. So are these similar situations of biting off more than you can chew?
Yeah, probably the other barrier they're trying to break through, one is to move upscale. You know, they want to beat Toyota and GM. And the other is they want to sell cars everywhere. They want to go global. So Geely, Great Wall, Chery, I mean, they're selling in other emerging markets, Saudi Arabia, places like that, but they're not in the West yet. So they've been sort of pushing there as well, but then in the last year, Great Wall, their sales have fallen about 22% for overseas sales in the last year. That's about 75,000 cars. So yeah, they took a little bit of a blow on both sides there, moving upscale and moving globally. But I think these are short-term moves because they're pushing the boundaries.
And finally, final story. Alibaba is moving closer to IPO, and one of the biggest winners is definitely going to be Japanese company Softbank. And their $20 million investment 14 years ago is now likely to be worth of $58 billion. So since Softbank owns 34% of Alibaba. So Jeff, how do you see this Softbank investment? This may be the greatest investment for all time. I'm not so sure anyone else has ever done that before, but we know that Softbank has a very smart China strategy, and they have been making investment in tech companies since around 1999. So how did Softbank do so well? Right.
The numbers are pretty amazing. I mean, they put in $20 million 10-plus years ago, and they're taking out $58 billion. I mean, I'm trying to find something similar to that in investment history. I don't know if I can find it. But I think their strategy is great. You know, they're a foreign investor, which is always a little bit difficult in China. But they're technology-focused. They come in to early-stage companies, and they don't say, hey, we have a lot of money we'd like to invest. They say, we have expertise, we have technology. And I think that's really what, young Chinese technology companies want. They want a partner that can bring them knowledge and expertise. And then, they get a return on that, but long-term it'll be owned, by Alibaba. So they invest, they help them, and then they exit with their profit. And that's a really good strategy for a foreign investor.
Well, thank you, Jeffrey Towson, Professor of Investment at Peking University Guanghua School of Management.
Thank you for that.